Everybody has been anticipating that the Federal Reserve would cut interest rates basically from the day they started talking about raising interest rates now years ago. And so far, every single person has been wrong about that prediction. The reason for that is because of record-breaking inflation that stuck around far longer than most people anticipated it would. But this time, people may actually be right about the Fed's coming rate cuts, at least in the short term. If you don't know who I am, my name is Joe Brown. I am a former stockbroker turned YouTuber who spent years advising the top 1% on how to manage their wealth. After making enough money to leave the corporate world behind, I turned my attention to teaching regular people financial techniques that exist outside the mainstream, things you'd typically never hear from a regular broker or financial advisor. And one of those things is successfully navigating the different phases of the long-term debt cycle, which is what we're looking at right now. Because make no mistake, financially speaking, the place that our country is right now is not unprecedented. We have been here before. So if we want to understand what is happening right now and where we are going, all we have to do is look back the last time we were here. That brings us to the early 1940s when the US debt to GDP ratio was right around 120%, the exact same place we are right now. The government spent the next 40 years after that deleveraging until in the early 80s, their debt to GDP ratio had bottomed out. It then spent the next 40 years after that leveraging up yet again until we capped out where we're at today at around 120%, which means the next phase of the long-term debt cycle is not going to look like the last 40 years. It will look like the 40 years preceding it. In other words, we are in this phase of the debt cycle where the government needs to deleverage yet again. Another way to look at this is interest rates. The chart you're looking at right now is the long-term chart of the 10-year US government bond. You can see interest rates had bottomed out in the early 40s. Interest rates then took the next 40 years on a roller coaster up higher and higher until they peaked in 1980. And from then, they took the next 40 years riding the escalator down until they bottomed out again in 2020, just like they did in the early 1940s. We have already started the climb upwards in interest rates because we are now in that phase of the debt cycle where the government must deleverage its debt to GDP ratio, and that is going to push both prices and interest rates higher for longer. But why? What is the mechanism, the cycle that pushes things in this direction? Because we are looking at this as a long-term debt cycle, but we have to understand there are short-term cycles that drive the long-term cycle. So let's take a look at where we are right now. The government is facing severe financing problems, which means they're trying to borrow money. Every time they borrow money, they have to pay higher and higher interest rates for it, which means interest rates are becoming the largest line item on the government's budget. The US government is paying well over $1 trillion per year already on just the interest on its debt. And the more it borrows in order to pay that interest, the more it drives up interest rates from issuing more debt, and the more money it has to spend on interest on that new debt as well. And so in order to deal with this problem, the Federal Reserve steps in and helps out one of two ways. Number one, they lower interest rates for the US government. Number two, they buy some of that debt. Since nobody else has the money to loan to the government, the Fed steps in that place. It's called debt monetization or quantitative easing. Now, this makes spending easier for the government then. It lightens up their load so they're able to spend a little bit more, or in some cases, a lot more. Because this new extra spending is driven by an expansion in the money supply, it drives inflation up higher yet again, which means once this gets going, we should expect inflation to shoot right back up higher like it did in 2021 and 2022. As a result of inflation and prices moving higher, interest rates across the board for everybody outside of the US government shoot higher in order for lenders to be able to protect themselves from currency debasement. This is why, despite the fact the government was able to deleverage their debt to GDP ratio from the 40s through the 80s, you still saw interest rates moving higher, despite the fact that there were things like yield curve control going on and all sorts of Federal Reserve shenanigans to try and help the government deleverage. Now, once again, these higher interest rates start causing problems for the government. They run into issues with being able to borrow and spend all the money they need. So then the Federal Reserve has to step back in again can with lowering rates or quantitative easing or both. This allows the government to spend more through the printed money, which drives up prices, sending inflation higher, which drives up rates, which causes government funding issues, which means the Fed has to step back in with lower rates and QE. And you end with a bang like we did see here in the 70s when interest rates and inflation shot through the roof through a massive and quick monetary event. In the case of the 70s, it was delinking from the gold standard, robbing dollar holders of their purchasing power while it got transferred to the state. And this time around may look like a massive round of debt monetization or QE, buying up all government debt, or could be something else. So yes, it is very likely, especially if the economy hits some speed bumps, we start to see some hiccups show up in the official data, that we will see the Federal Reserve lower rates. This will make things easier for the government to borrow and spend, which will ultimately drive up prices. This higher inflation means higher rates for everybody else because, again, we're in this longer term cycle. So yes, we get these short term drops that make spending easier. That drives everything higher yet again. And just like happened from the 40s through the 80s, we will see interest rates and inflation move higher for longer. All the while, the government will be using this cycle in order to deleverage themselves from a debt to GDP perspective. This is essentially a long-term transfer of wealth from the economy and individuals to the government, to the state. If you want to protect yourself from this, you have to do a few things like, number one, buy hard assets that appreciate from a dilution in the currency rather than get hurt by it. Number two, expect volatility, because top-down central planning of economies like this, even if the goal is just to help a government deleverage, never go according to plan, and there are always unforeseen circumstances, consequences that pop up like whack-a-mole out in the economy. These represent problems for traditional asset allocation and opportunities for people who are paying attention. Make no mistake, you are going to have to pay closer attention to your investing than you probably ever have in your life. Because if you don't manage your wealth actively, you will most likely lose it passively. And if you're looking for somebody to walk you through exactly what comes next for our nation, and most importantly, what you can do about it, I've just launched my newsletter and I'm calling it Letters from a Heretic, and it's completely free. It's the only place where I'm going to do deeper dives on financial topics that I seriously doubt you will hear anywhere else. As soon as you sign up, you will receive my 5-day series called The Most Dangerous Ideas in America. These are ideas that are so powerful and potentially devastating, they could reshape the economic landscape of America and even the world, changing everything from how much money you have in the bank, the types of food you can afford to eat, and even when you can retire. We're going to talk about things like the real reason we may be on the verge of another world war, the rise of the House of Saw, the true location of the financial all-seeing eye, a secret manuscript that actually predicted the end of America and what that means for your wealth. We'll talk about America's coming dark summer and even the US dollar's final phase. If you're interested in receiving that and having me walk you through more complex financial topics that allow you to make better decisions, not only about how to protect your wealth, but also how to grow your wealth, especially during times of crisis, all you have to do is click on the link in the description below, submit your email, and I'll start showing you everything I know. As always, thank you so much for watching. Have a great day.